The recent market gyrations have prompted an immediate review of portfolios, and all of a sudden, investors love those boring old bond positions. Although they're widely owned, many still don't really understand how these investments work. When you buy a bond, you're actually lending money to an entity, a government, a state, a municipality, or a company. You're lending for a set period of time, from 30 days to 30 years, at a fixed rate of interest. At the end of the term, the borrower repays the obligation in full. Sounds great, but bond prices can fluctuate during the term based on the general direction of interest rates. When interest rates rise, bond values drop. And not all bonds are created equal. If you choose to lend money to the U.S. government, you're pretty much guaranteed to get your money back. But as investors in Detroit, Puerto Rico, and Greek bonds now know, sometimes the borrower doesn't repay the loan. And even if the bonds are paid in full, the promised interest rate can be worth less over time due to inflation, which eats into the fixed stream of payments. The worst calendar year for the broad bond market was 1994, when returns were minus 2.9%. So yes, you can lose money in the bond market, though the magnitude of the fluctuations tend to be smaller than those in stocks. Just because bonds can have bad periods of performance doesn't mean you should avoid them, but you do need to be careful about the types that you put inside your portfolio. For more on how to position your bond holdings to weather higher interest rates, you can go to JillOnMoney.com. In New York, I'm Jill Schlesinger.